The bond market is absolutely right to be concerned about what's going on. The US is running a deficit of about 6% of GDP. So it is taking in much less in taxation than it is spending.
Hello and welcome to the Personal Investor Podcast. I'm Ed Monk and I'm joined today by Tom Stevenson to talk about the future of the world's most important investment market. That is, of course, the United States. Will its dominance continue, or is it time for investors to look further afield for their returns? Tom, welcome along. How are you?
Very well, thank you, Ed.
United States and America. We've become used to the US being a bit of a special case, really, when it comes to investments. Higher valuations on its stock market than anywhere else in the world. The biggest companies, but also the fastest growing companies of that size anywhere in the world. We're going to talk today about whether that's ever likely to change. But first, what has been underpinning that special sort of role that the United States has had for investors?
Well, some of the things that you've mentioned there. I mean, American companies are extremely profitable and productive compared to companies in the rest of the world. They benefit from a huge, homogenous domestic market. And that has resulted in many investors around the world wanting to be exposed to that market, not least also because the sectors to which America is heavily exposed are some of the fastest growing parts of the global economy, particularly technology. So add all that together. Higher growth in profits, more sustainable growth in profits, and investors have been prepared to pay a higher valuation multiple for American companies than they have for other companies around the world.
And that's been going on for many years, hasn't it? So, you put the fundamental case there, but there comes a point when sort of investors have learned behavior, and the learned behavior is your money does better in the United States than it does anywhere else.
Yeah, absolutely. I mean, really, since the financial crisis, America has outperformed the rest of the world. It's particularly been the case over the last 10 years or so, which is when the tech story really took off. And in addition, other markets around the world had their own homegrown problems, if you like. I mean, thinking particularly about the UK with the Brexit vote. Mm-hmm. There was a real divergence from that period. So over the last 10 years, a real divergence between the US and other markets such as the UK.
And investors have just found more and more excuses to buy more of the US. That might be sort of directly through kind of US focused funds, but any kind of global funds is going to have an increasing amount of the US in it. Any technology focused fund will have the same. Any sort of just passive index fund is going to have a large proportion of the US, isn't it?
And it becomes sort of self-fulfilling because, I mean, as the US becomes a bigger and bigger part of global markets, then it makes sense for more passive money to be directed towards the US. It accounts for about 70% of the value of global stock markets. So more and more money is going to head that way.
So that is the background. Then we get to this year, which I guess is what we're really here to talk about. A number of things have happened. We've had this big shift in US trade policy, of course. Why does tariffs and a different approach on trade, why does that undermine potentially this case for the US holding this dominant position?
Well, I mean, fundamentally, the introduction of tariffs is potentially bad news for all participants in global trade. But I mean, what is interesting and what I think it's taken investors a little while to understand, but they now seem fully cognizant of the fact that actually it's potentially quite bad for the US economy itself, both in terms of the growth of the economy, but also in terms of the potential to ignite inflation at home. So I think that if you roll back 6 months or so ago, when Donald Trump was first arriving in the White House and starting to talk about tariffs, I think that there was a feeling that this would hit other countries harder than the US, and actually was probably an argument to weight yourself more towards the US. And I think that has been the narrative which has changed over the last few months.
That's right, because we've had even recently, your previous experiences of things that come along and not markets, and potentially not the US market. But it just feels as though, if the US market is going to fall, everywhere's going to fall at least as badly and maybe worse. But this does feel different, doesn't it? Because, as you say, the more tariffs that America imposes means basically that American consumers ultimately have to pay those. And they're going to be inflationary at a time when inflation is slightly above target anyway. So that feels like a more uniquely American problem. And actually that's played out in the behavior of investors, hasn't it? And a flight away from the United States, notwithstanding the fact that a lot of it has been unwound as the White House has stepped back from those tariffs.
Yeah, I mean, as we speak, the US stock market is back at or close to its all-time high, and that may be a bit puzzling in some regards. I mean, you might think, well, why is that the case, given all that's going on with trade policy and fiscal policy as well. But anyway, it is the case. But there's competition for investment assets around the world, and at the same time as the outlook for American markets has maybe deteriorated, we've also seen the outlook in some ways improving for other markets. So if you take the European market, not specifically the UK, but the rest of Europe, you've got an interesting combination there of, in Germany, for example, an easing up of the fiscal rules to allow more money to be spent by governments. That has been seen as positive by stock markets. The European Central Bank is reducing interest rates much faster than the US Federal Reserve, for example, is cutting interest rates. So at the same time as the US is starting to look a bit less relatively attractive, other markets are starting to look more relatively attractive, and so that's creating that shift.
Yeah, and in the US, you talked about the market being back to its high. Investors seem to be looking on the bright side of everything. The tariffs they're not as worried about. Not they are still being imposed, and there will be tariffs to be paid. And we're going to see whether they're inflation. We've got inflation figures this week in the US coming up. But they're also sort of looking forward to a big tax cut for companies potentially. And so they're finding reasons to push shares to new highs. But shares aren't the only investment market, are they? We're also here to talk about the bond market. And we're seeing potentially problems there from a US point of view in the bond market as well.
Yeah, so what we're seeing in the bond market is we're seeing a rise in bond yields, and the price of bonds and their yields move in opposite directions. So rising bond yields are bad news for holders of bonds. The reason why bond yields are rising is slightly complex, because you would expect, all other things being equal, that if interest rates were stable or beginning to come down, which is the situation that we think that we're in, you would expect bond yields to come down. But actually, they're doing the opposite. And that's particularly the case for bonds which have longer to run until maturity. And so we have to explain a little bit of jargon here, something called the term premium. And what that refers to is the extra income which investors demand from bonds in order to hold bonds for a long period of time. And there are a couple of reasons why they might demand that extra income. One is if they felt unsure about the reliability of policy, government policy in the country to which they're lending money. And clearly in the US, there has been, a deterioration in the sort of predictability and of US government policy. So there's that concern. And then there's a second concern, which is that, a bond is a fixed income investment. Its value will be eroded over time by inflation. So if you're concerned that inflation is one possible product of the policy changes that you're seeing, then you're also going to want a bigger income to compensate you for that fact. And both of those are true at the moment. So investors are looking at the US bond market, and they're thinking it's less of an obvious safe haven than maybe it has been in the past. And so they're pushing yields higher, and that in turn has a knock-on effect on the stock market, because it makes shares relatively less attractive from an income perspective
Yeah.
because you can get a higher income from bonds.
Yeah, and there's loads to
It's a
unpack
lot
in all
there,
of.
I know.
There is
Yeah,
loads to unpack,
yeah.
but it's a really worthwhile topic, because the bond market, as we've seen, think back to 2022, the mini budget here in the UK, the bond market can act very, very quickly, and it can derail a lot of sort of government policy, can't it? And we've had all this talk this year of Elon Musk, Doge, cutting spending. You'll have deficit hawks in US now criticizing the level of borrowing that's going to happen for the government's plans to be enacted. It's going to add to the borrowing that the United States has to do. And if the bond market doesn't like that and it insists on a higher rate of return in order to lend that money, the US is going to have potentially a problem. This is where it all plays out hypothetically. It's got to refinance its debts, and it's got to then do something about that, either spending much less, and it's already cutting spending in lots of areas, or taxing more, which is exactly what it doesn't want to do. All of those things can be harmful for economies and growth, and can be very painful.
And the bond market is absolutely right to be concerned about what's going on with the US tax and spend situation, its fiscal situation, because the US is running a deficit of about 6% of GDP. So it is taking in much less in taxation than it is spending. And there are periods in the economic cycle when that is legitimate and makes sense. At a time of crisis, or if the economy is going through a slump, then it makes sense for the government to step in and to spend money to juice the economy and create growth. That's not the case in the US. The US economy is firing on all cylinders. It is growing pretty strongly, and yet the government is still running a big deficit. So there are many people that say that is simply unsustainable. And that is the third additional fear that the bond markets have: policy uncertainty, inflation, but also just the level of debts and the growth trajectory of those debts.
Yeah, because the US government is always going to be able to pay those debts from a sort of a nominal terms, right? Like it can you make the money to pay it back, but the bond market presumably is worried that the situation will get worse, and that if it buys bonds at 5%, say, that they're going to be paying 6%, very shortly, or what have you, and it's not going to be willing to do that, and then the problems come.
The rule of thumb is that debts, a country's debts, are sustainable as long as the rate of growth of the economy is in excess of the cost of borrowing. And I mean, it makes sense at a country level, just as it makes sense at a company level. If you are growing a business very fast, then it makes sense to borrow money to fuel that growth. Mm-hmm. If the cost of borrowing is higher than the growth you're able to achieve, then you're just making problems for the future, and that works at the country level just as much as at the company level. Yeah. And the expectation is that the sort of underlying growth rate of the US economy is going to fall in years to come below the level of the cost of borrowing, and that's where the anxiety comes for the future.
One of the things you'll often hear in discussions like this, more kind of technical jargon to explain, but you'll hear people talk about the US dollar being the world's reserve currency, and why that's a kind of special status, and why the United States, needs to worry a bit less about its borrowing and funding its borrowing than other countries. What does that mean, and how's it relevant to this?
Well, the importance of the dollar within the global financial system is very important. It's the currency in which much of global trade is denominated, but it's also the currency in which many other countries will hold their reserves. So, a country like China, which has grown a big pile of money by exporting a lot of goods to the rest of the world, has money which it needs to park somewhere. And one of the places that they park that money is in the form of U.S. Treasury bonds. For the reasons that we've discussed. There's very little chance that the U.S. government will renege on its debts. It's a safe place to park your money, and the fact that the U.S. can offer this facility, if you like, is what we mean when we say it is a reserve currency, and the knock-on impact of that, the benefit for the US, is that because so much money is gravitating towards the US, there is demand for US dollars. It actually keeps the cost of borrowing lower than it would otherwise have been. It has a name. It's been described as the US's exorbitant privilege. It finds itself in this privileged position of being able to borrow more cheaply because everyone wants to lend money to it.
Yes. Now you've written on this as well this week, and you spelled out, as we have, the bad news, maybe the case for why the United States faces challenges to its position of dominance in the world. But what about the more positive case? What are the reasons why the US might, in fact, continue to have this special role? What is the case for continued US exceptionalism?
Yeah. Well, one of the things that might happen, and this is what the government, the US administration, I think, is counting on, is that the US economy will continue to grow, and so it will grow into this debt situation, and so it's actually not as much of a concern as maybe the markets think it is. The US has a lot of long-standing advantages over the world, and we mentioned some of them at the start of this discussion. It has a huge domestic market, a homogeneous market. Europe is a big and rich area as well, but it has disadvantage in that it has many different languages, it has many different regulatory systems. It's quite fragmented in many ways. The US is not. The US is one big homogeneous market that enables businesses to grow.
It's a huge pond to play in, isn't it, if you're an American company?
Absolutely. So there are other advantages too. Demographics is a big positive for the US. It actually has a growing workforce, and the GDP, the economic output of a country is determined in part by the size of its population and by its productivity. Now, the US has advantages on both fronts. It actually has a growing working population, which is not the case in, say, Europe or in Japan, or where the workforce is actually shrinking.
I was surprised by those statistics. I think you even mentioned China as shrinking as opposed to America growing.
Yeah, the Chinese workforce is shrinking. It's an aging population, and it's a shrinking workforce. Partly because of immigration, which of course is a red button topic in America. But the positive of immigration is that it keeps the working population on the up, growing. So demographics are a positive for America. Its energy security is very strong. It's the biggest producer of oil in the world. It's a net exporter of oil thanks to the shale revolution. So there are lots of positives, which I think. There are many reasons to worry about America, and the markets and individuals are worried about what's going on in America, but there are also some very long-standing advantages over the rest of the world, and I think it remains to be seen how that balance works out in years to come.
Okay. Well, Tom, I think that just about covers it. And if you found this interesting or useful, please do hit the like button. And maybe even subscribe to the channel, or share, or leave a review. It's going to help many more people find this content. That is it for now. Tom, thanks for joining me.
Thanks, Ed.